Welcome. What's with rates? For Thanksgiving week. Nova 25th, 2024. I'm Jason Iacovelli, here to give you the inside scoop on what's happening with the markets. Specifically the 10-year Treasury yield and how it's going to affect mortgage rates. Spoiler alert, there's a good chance we'll see a little relief coming our way this week. All right, let's start with the US dollar. It's been on a bit of a tear this month, up 3.57%. That's a big deal because a strong dollar usually means foreign investors are piling into U.S. Treasuries, driving up demand and pushing yields and mortgage rates lower. But here's the catch. The dollar might be peaking. We're seeing signs of a potential reversal, which could slow down that flow of foreign money into Treasuries. If that happens, yields could tick up slightly, but historically December isn't kind to the dollar. So it's something to watch but not panic over. Now let's talk gold. Gold's been slipping this month, down about 1.12%, but there's some momentum building for a comeback. Why does that matter for Treasuries? Simple. When gold rallies, it's usually because people are nervous and shifting their money into safe assets like gold or Treasuries. That could push yields lower, which would help bring mortgage rates down. So, if gold gets its groove back, it could be good news for anyone watching rates. Over in the stock market, the S&P 500 is having a great month, up over 4%. Normally, when stocks are hot, people aren't as interested in bonds, and that pushes Treasury yields higher. But here's the wild card. It's Thanksgiving week. This is one of the most volatile times of the year, and if stocks get a little wobbly, we could see a flight to safety into Treasuries. That would push yields down and give mortgage rates some breathing room. Crude oil is another piece of the puzzle. Prices are up slightly this month, but still way below their yearly opening price. That's important because oil influences inflation expectations, and inflation is a key driver of Treasury yields. With oil prices staying in check, there's not a lot of upward pressure on yields from the inflation side of things. So it's another point in favor of rates holding steady or even dipping. And then there's Bitcoin. I know. It feels like Bitcoin shouldn't have anything to do with mortgages, but hear me out. Bitcoin's flirting with the 100,000 level, and if it breaks higher, it could signal that people are feeling more confident and taking on risk. That would reduce demand for Treasuries, nudging yields higher. But if Bitcoin stalls out, it could go the other way, with some of that money flowing back into bonds, helping to push yields and mortgage rates lower. So what's the bottom line? When you piece it all together, the dollar potentially softening, gold looking ready to rally, Thanksgiving volatility, and oil keeping inflation tame, it's all pointing toward some downward pressure on Treasury yields this week. And since mortgage rates tend to follow the 10-year Treasury yield, that means we could see a slight drop in rates. Now, is it a guarantee? Of course not. This is the markets we're talking about. But if you're shopping for a mortgage or keeping an eye on rates, this week's setup is looking better than it has in a while. Thanks for tuning in to What's with Rates? I'll see you next time with more insights to help you navigate the madness of the mortgage world. Take care.